Choosing the wrong term length could leave your family uninsured at the exact moment they still need you most. Term life insurance is really a timeline. The question is not only how much coverage you need, but how long the protection must stay beside your family. Think of 10, 20, and 30 years as three different paths. The cheapest path is not always the one that gets you safely to your destination. Your term length is the period your policy stays active while you pay the required premium. If you die during that period, your beneficiaries receive the death benefit. But once the term ends, the coverage usually ends too, unless you renew it, convert it, or qualify for another policy. Longer terms usually cost more because the insurer is locking in your age and health risk for a much longer period. The right term is the one that reaches your final major obligation, not the one with the smallest monthly number. Start by asking one question. When will the people who depend on my income realistically stop needing it? Think about income replacement, your mortgage, your children's education, major debts, and any business obligations tied to you. A 10-year term works best when your financial need has a clear and relatively close ending. It may fit a small remaining mortgage, temporary debt, a short business obligation, or a transition period before retirement. The risk is simple. If your need continues beyond 10 years, replacing the policy later could be far more expensive because you will be older and your health may have changed. A 20-year term is the middle path, and for many families, it matches the years when financial pressure is highest. It can cover much of the child-raising period, a large part of the mortgage, and the years when a household depends heavily on one or two incomes. The advantage is strong protection at a more manageable cost than 30-year coverage. The drawback is that your need may still exist when year 20 arrives. A 30-year term is designed for long obligations and maximum rate certainty. It often makes sense for younger buyers, new parents, people with 30-year mortgages, or anyone expecting a long dependency window. You pay more each month, but you also reduce the risk of needing new coverage in your 50s or 60s. Imagine your mortgage has 27 years remaining and your youngest child is 3. A 20-year policy may look cheaper, but it could end while both obligations still exist. You do not always have to choose only one path. Laddering uses two policies with different terms so your coverage decreases as your obligations disappear. For example, one policy can protect a short debt, while another stays in place for long-term income replacement. This can cost less than keeping the maximum coverage for 30 full years. The biggest mistakes are choosing the shortest term only because it is cheaper, depending entirely on employer coverage, and ignoring the option to convert later. Here is the rule. Identify your longest major obligation. Choose the closest term that does not end before it. And make sure the premium remains affordable in both good years and difficult ones. To compare 10, 20, and 30-year term life quotes side by side, visit Quote Maestro today.